Welcome one, welcome all to DeFi Crypto and Airdrops. I am Mike, aka Veteran Crypto, and welcome to our Wednesday show where we go DeFi deep with David and Jake Call from Metrics Finance and is it Luminary Assets?
Yes, Luminary Assets and
Okay.
Builder Wealth.
Yeah, awesome. And David, of course, with DeFi University, we just got done with his live call in DeFi University, so we're jumping right into this. And today we're going to talk about a little bit about how we're each positioning ourselves for hopefully what's going to be October. And we're going to talk a little bit about the government shutdown and historically what it's done to markets, such as back in 2018. And then we want to touch a little bit on a new project that we just did a deep dive on called Plasma, or XPL is the ticker. And I guess, David, you were saying it was going live on Pendle.
Yeah, so I saw on X that the team over at Pendle posted that they were going to take the uh, plasma market live tomorrow. So looking forward to that.
Awesome. All right. Well, let me hit the socials and we'll jump right into it. So we'll transition over. So I just want to make sure that everyone knows where to find everybody. So if you want to pop over and be a part of the conversation, you can find us on YouTube at DeFi Crypto Airdrop. And then if you scroll down, you can see the brother channels. That's where we had Discover Crypto, my boy Jeff over at Blockchain Report that does the deep dives on airdrops. Druth over at Blockchain Basement. Of course, Jake Call, at DeFi Income. That's his channel where he does a lot of really great content on DeFi. David just started a channel called for DeFi University, and he's starting to drop videos on there. And then, of course, we got Kelly over at BitLab Academy that does a lot of technical analysis and focuses more on trading. So that's our family of channels right there. But on each of the episodes, and then also in the description of the channel, if you want to help support the channel and help support these two fine gentlemen, if you come down, you'll find in all of the links, there is a link for Metrics Finance, which is an awesome tool that Jake has developed that allows you to track your liquidity pool positions and then also allows you to simulate positions. And here pretty soon, and we'll get into it here on this episode, but he's about to launch. David's been helping him with a borrowing and lending aspect, as far as being able to track those positions as well. So some exciting stuff coming there, to where you're going to be able to track a whole host of different DeFi positions, and then of course the link to David's DeFi University. So if you want to go sign up over there, he has a website as well with a lot of great free content. And then it's just $97 a month for his advanced course where you can get on the daily live calls and ask questions, be part of the community, find mentors, things like that, which are so very important in DeFi and when you're dealing with these complex topics. Having somebody that can help you navigate the minefield and help you kind of learn the verbiage and avoid mistakes is so valuable, and it's going to save you a ton of money. So
Mm.
well worth it. So, Jake, why don't you kick us off? Kind of what are you seeing that's going on in the markets? For the potential for October and how you're positioning yourself.
I love the coincidences and the timing in crypto, because when we're like, yeah, September is going to see a nice little dip or whatever, it really comes down to, while we see catalysts that actually create these dips, it's like they always fall into specific months, with September being red previously, and seeing dips in previous months. We just happen to have, the fact that there's a rate cut and it's, pre-priced in. Then obviously we see a dump after that. And then as soon as October hits, literally October 1st, like crypto completely pumps because of the government shutdown and whatnot. So it's like the timing here is just, it's immaculate, truly. And the fact that it just falls on these specific months and creates patterns. But yeah, I mean, as far as like markets go, I have a couple positions that are doing quite nice. Obviously, that Bitcoin position that I spoke of last week where I dumped like 30 grand into 5x leverage. Not gonna lie, I was sweating when I was at $109,000. I'm like, okay, just not gonna open up pipe for liquid, fighting the urge not to add more
So
capital.
Jake, you know what you can do? Sometimes I like to take black tape and just tape over where it shows the P&L sometimes. I'm just kidding.
Yeah. But again, that comes down to emotions, and over time I've learned to manage my emotions and whatnot when it comes to specifically DeFi and crypto.
I think
Because
I'm
that's
dead
the
inside.
industry I'm active in. Like in my stock portfolio, I don't open Charles Schwab every day. Like I maybe open it once a quarter for my IRA contributions and whatnot. But not looking at it actually helps, because otherwise I'm going to dive too much into the weeds and whatnot. But that's my tangent. I'll pass it over to David.
Yeah, man. So just broadly speaking, in DeFi University, what we've been focusing on a lot is, helping members to cultivate the mindset of a consistently successful DeFi operator. I think that the strategy portion is only 20% of the game. I think mindset is 80%. And it can be really difficult sometimes to cultivate that mindset so that you don't make emotional decisions. But if we just take a look at markets real quick, what I've been posting about in DeFi University is that I thought that the government shutdown would be a case of bad news being good news for markets, because the government shuts down. It could mean, oh, we get more rate cuts, or there's more Fed liquidity, or there's more fiscal stimulus. And it seems as though all of those things are coming to pass now. So if you take a look at FedWatch, and the FedWatch tool allows you to track interest rate expectations, according to that dot plot and according to the Fed Funds futures contracts. And so what we see there is that as of today, there are now 3 cuts priced through the end of this year. And it seems as though the meeting at the end of this month, the Fed meeting at the end of this month, there is now a non-zero probability of a 50 basis point cut this month in October. So these rate cut expectations, pricing them in, it just means that markets can push a little bit higher. Now, another thing that we got today was ADP. So the ADP payrolls number came in today, came in weaker than expected. That's the private payrolls print. And the August number was revised lower, revised negative. So remember, the Fed has a dual mandate, and the mandate says maintain full employment and maintain price stability. So make sure that the labor market doesn't fall apart, and make sure that inflation doesn't run too hot. You can make what you will of the inflation mandate, but because the labor market seems to be significantly cooling, that gives the Fed cover to cut rates a little bit more aggressively. So, with ADP printing below expectations today, and with the US government shutdown, it seems as though there are more rate cuts that are starting to get priced in through the end of this year. So, there is definitely what looks like a melt up in motion in markets. I think we're going to just see the S&P, the Nasdaq, Mag 7, those items melt up into the end of the year. And why is that important for us as digital asset investors? Well, because these Mag 7 stocks, specifically like Nvidia and Tesla, they're positively correlated with Bitcoin and crypto. So if you see Nvidia breaking out to fresh all-time highs like what we saw yesterday, and then continuation today, or if you see Tesla ripping higher, those equity items are positively correlated with Bitcoin. So as we saw Nvidia rip higher, we saw Bitcoin push higher off of a level of support down there at 109, Jake, as you mentioned earlier. Now, another print that we got today was ISM manufacturing. And remember, this is all about Raoul Paul's everything code thesis. He bases a lot of this, a lot of his everything code thesis, my understanding of it anyway, is that he bases it on ISM manufacturing. And so if we're going to see manufacturing in the United States start to pick back up, probably with the creation of all of these massive data centers, well, that would be positive for the economy writ large. So looking forward to that. Another thing here is M2 money supply has been just continuing to print fresh all-time highs. And so you guys remember the correlation between M2 money supply and Bitcoin, how
Mhm.
people were curve fitting that. Well, there was definitely a positive correlation for about 18 or 24 months of this bull cycle. But do you remember anyone talking about M2 money supply last cycle? No. And the reason is it didn't express a positive correlation last cycle. That positive correlation this cycle has broken down over the last 6 months. M2 money supply has pushed to fresh all time highs as Bitcoin has lagged. But you know what has not lagged? Gold and AI stocks. And so it looks to me as though all of this liquidity has been flowing into gold and those Mag 7 items. But here's the new interesting correlation. If you take a look at gold with a 75-day lag, it seems as though when gold breaks out, prints fresh all time highs, and then starts to consolidate its gains, that's where you might see a little bit of a rotation into Bitcoin. I think we're seeing the beginning of that. And you can see that expressed in BTC priced in gold terms. So BTC in gold terms found support at long-term trendline support and has bounced over the last couple of days this week at long-term support. So important bounce. Another thing here, you guys, we get the beginning of Q3 earnings season in about 10 days. And earnings this year have been very strong, and the moves on those earning prints have been greater than the expected moves. So a lot of volatility around those earning prints, and we've pretty much seen companies beat to the upside. So really looking forward to getting Q3 earnings in 10 days and through the rest of the month of October. Now, one other thing here that's kind of interesting to note is that it's been 105 days since the S&P has broken or tested its 50-day moving average. That doesn't happen very often. I think from what I read, it was like the first time this has happened in like 30 years. So I'm watching not just the 50-day moving average, but I'm really watching the 20-day moving average for the S&P. Now, why am I watching traditional markets so closely? Well, because they're positively correlated with Bitcoin. So if we see the S&P continue to hold its 20-day moving average on the upside, then I think it could be likely that Bitcoin will have a positive October, a positive November, Moonvember, and hopefully we continue running into December. Um, one last item here, you guys. So bubbles can last for a long time. And I know that we've been taking a look at this circular funding in these AI names where, it's like you got NVIDIA extending a line of credit. They call it vendor financing. NVIDIA extending a line of credit to OpenAI, which then uses that credit to buy services from Oracle, and then Oracle buys chips from NVIDIA. And so it's this loop, this circular loop. And Elon Musk on X has referred to it as the infinite money glitch. So, it seems as though we're in some type of an AI bubble, but bubbles can last for a long time. And so, I've got a little bit of a stat here about bubbles lasting for a long time that I just want to run through real quick. So the Roaring Twenties, and I got this stat from the guys over at, I would have to open up my email, but one of the sites that I follow. It's called The Market Ear. And in the Roaring Twenties, the bubble lasted for 5 years, from 1924 to 1929. The dot-com bubble was also 5 years, from 1995 to 2000. The Japanese asset bubble, that was 3 years, from 1986 to 1989. Now, I wasn't aware of this one, but I guess there was a Mississippi bubble. It lasted for 3 years in 1717 to 1720, going back in time for this. And then, there's Tulip Mania. I'm sure that we're all familiar with the Tulip Mania in the Netherlands. That was 3 years long, from 1634 to 1637. There was a UK railway mania, lasted for 2 years. And there was a South Sea bubble. We're, I think, in an AI bubble right now, but these bubbles can last for a long time. And it looks as though we're going to see a reacceleration to the upside in these S&P items. I think that probably means if gold is able to consolidate its gains below $4,000, I think that probably means we see some type of rotation into Bitcoin through the end of this year. So, how am I positioned? Well, I'm long Bitcoin futures. I'm just using futures because it's very capital efficient. I can take on a ton of leverage. And because Bitcoin isn't all that volatile anymore, I don't really have to worry about a liquidation point at 100K. So that's pretty good. I like my Bitcoin exposure there. I was able to, get a decent entry. So pretty happy with that. And then I've got a ton of exposure to ETH and a bunch of ETH LPs. So I use the ETH LPs to generate the cash flow that I use to fund my life and take care of my family. And I'm in on Aave, supplying ETH and borrowing ETH and stables. My plan over the next couple of weeks here into October is to start to buy back that borrowed ETH that I borrowed around $4,500. So that's the majority of my positioning. And what I'm looking forward to is I'm thinking about a handful of tokens on Pendle, so that I can get some exposure and earn some fixed yield on, stuff like Hype or BNB or ENA or Pendle. Those four are, a couple of tokens that I'm looking at, but on Pendle. If I swap into a PT, earning fixed yield on those tokens, and I earn that fixed yield until the end of November, it's kind of just a nice bonus. So I've been looking at something like that. But
All right.
that's market update.
Nice. Thanks, David. Jake, what are you seeing in the markets, and how are you positioning yourself for what we hope to be Uptober?
Yeah, of course. So as you know, if you've been watching for a while, you guys probably know David is very, very good on his positioning and like not necessarily timing the market, but getting pretty damn good entries, I would say. And my strategy is a little bit different. My strategy is like I want to buy towards the beginning of the market and I want to sell towards the end of the market, and just kind of hold throughout that process.
Sounds like
And
my
again,
strategy.
there's pros and cons to both because somebody
Yeah.
coming in right now, they can't just run my strategy,
No,
because I've been in since, I'm
it's
buying
too late.
ETH. Yeah, I'm buying ETH January of 2023 at a price of how much was it? Like 1,200
15.
bucks or something, maybe 1,300 bucks. Yeah. So it's like, it truly is too late in that instance. So it's like, I resonate with both strategies. But during my whole process, during what I'm doing, I'm accumulating more assets. And what I just want to show you guys here is the results of that, right? And I'm not entirely sure what I shared last time, but I think I did mention something along the lines, and I'm just going to pull up my screen, Mike. I mentioned something along the lines of how I essentially had a position, Ethereum to open serve, that didn't do so well, basically. What ended up happening was the position basically lost a ton of money because of serve. So what I did is I took that money and I threw it on ETH, and we just wait for ETH to go up. And as you can see, the entry price over here is 41.51. Now the market price is 43.21. It's plus 400 bucks. So I didn't have to worry about taking the volatility with OpenServe. And I don't really have to worry too much about liquidation. So again, that's starting to play out just by adding a little bit of leverage to Ethereum. That Bitcoin position that I opened with, 5x leverage over here on $30,000 or so, that is plus $7,000 right now, which is a safe amount. And again, as I was saying, I was sweating a little bit while we're at 109, like man, and a lot of it is like, oh, I should have waited, and just second guessing yourself. But again, you have to take the mindset that you're not going to get the perfect price. So get in, as long as you're comfortable, stay in. Simple as that. Don't try to maximize all these extra couple percentages or whatever. And then altcoins, they haven't quite picked up yet, as you can see. So I'm still waiting on those to kind of start to hit. But in terms of what I'm actually doing in my portfolio, I have a lot in HODLs and I have a lot in Hyperliquid. As you can see over here, I have like roughly 9.5 of Tau. I have 5.6 of Hype. I have 4.9 of Ethereum, 4.7 of Aether. A lot of these need to be filtered into liquidity pool. I will say that. It's just capital that's been sidelined for now. As far as my Aave goes, and once again, I'll just show you over here. We can also pull up my wallet address on metrics. Now, this isn't live quite yet, but I get special privileges.
So,
Um,
are you involved with the owner?
I might be a little bit. I actually have the largest plan on metrics. It costs a couple $100,000 a year.
Yeah, yeah, yeah. Yeah, you have like the one account that
Yeah,
costs
yeah,
the most.
yeah. I get the one with no rate limits and everything. But yeah, all jokes aside, basically the integration that we're building, I wanted to show you over here so I could kill two birds with one stone. I have Aave collateralized, I have Link collateralized, I had wrap Bitcoin. A lot of that's in Bitcoin. I have Ethereum and I have wrap staked Ethereum. And then again, a lot of that's in Ethereum. And I'm borrowing some USDC. Majority of this borrow has just been stuck back into the Lin. So a little bit of leverage over here on its own. Um, and then over on the Polygon network, I just have some Matic X waiting for that thing to perform basically. But yeah, you can see my net APY for this. Now, this does not factor in native yield of wrap staked ETH quite yet. It will, but it does not quite yet. So yeah, that's kind of the integration that we built so far. Again, it's V1 just for lending. Pretty cool stuff. Soon you'll be able to see profit loss and all those little details and
Dude,
whatnot. But
I'm so excited when you and David started talking about this after one of the shows, and you were asking David kind of what he would like to see from his standpoint because obviously he makes his living doing this, so
of course,
great resource, and he started just rattling stuff off, and I was just sitting back and I was just like, this is going to be awesome once it
great.
actually pops, and I'm amazed at how quickly you put this together because I mean that
Me
was only
too.
what a couple weeks ago.
Yeah,
Yeah, this is amazing.
it took about
Yeah.
a month. And again, the profit loss that's still in the works. The main thing about that is the subgraphs have to sync and whatnot. However, one of the members on our team, really great team member, he's on PTO right now, but basically he worked every single weekend and he worked like all day, every day, basically for a whole month straight. So he
Real,
definitely earned his
real
share.
quick, I want to throw this out here before I forget, but Jake is looking for a developer. So if there's any
No,
of you out that
yeah,
are interested in some remote work, it's and on a great project. If you're in crypto and stuff like that, I mean, this would be kind of a. I wish I knew had that skill set. I would do it.
yeah.
But by all means, go to Metrics Finance. Link is in the description of all the episodes and on our YouTube channel. So by
Yeah,
all means, reach out to him.
yeah, you guys can just click this little chat bubble and just start a message and we'll get it. Our AI will respond to you at first, but we get all the messages even when you're talking to the AI. We step in, whatnot. But that
Yeah,
reminds me, Mike.
Jake was creeping on me the other day. I was talking to the AI, and Jake was like, "Hey, what's up?" I'm like, "Oh, okay."
I'm like, what's up, man? Yeah. But yeah, I mean, in terms of this, all this lending integration across Discover, Simulate, Track, and everything like that, that is coming out on October the 7th. And again, I've just unveiled like a little bit of it. But if you guys go to event.metrics.finance, simple as that, event.metrics.finance, you'll be able to RSVP over here. So you can just throw in your name, throw in your email, just as an example. Throw in your phone number too. We're not going to spam you or anything like that. We're just going to send you a notification right before it starts. So that way you can be like, oh yeah, it's starting right now. Hit RSVP. It will get you prepared over here. So it'll send you to this page where you can add it directly to your Google Calendar, your Outlook Calendar, or your Apple Calendar, depending on what you use. And also, if you're signed into YouTube on your browser, you can hit notify me right here, and YouTube will also send you a notification. It's at October 7th, 12 p.m. Central Daylight Time, and 1 p.m. Eastern Time, basically. But this will automatically convert, show you what time it is and everything like that, because we're going to do everything live. We always do everything live. Last one, we had a ton of people there. We had a huge turnout rate. And yeah, I mean, I'm pretty excited for this. So event.metrics.finance. That's enough of me shilling back
No,
to
no. The thing is, I don't mind, shilling good, solid tools and
of
projects. I
course.
mean, obviously, that none of this is paid or anything like that. This is 100% a tool that I use. I know it's a tool that David uses. Many in our community, use this tool. Because I know when people use our link that, I get, I see, who it is that I'm driving to the site and,
Yeah.
who actually becomes a paying customer basically. So yeah, I mean I get to see all those analytics, which is really cool.
Yeah.
But again, this is a tool that I personally use.
Yeah, 100%. I appreciate that, Mike. And just to bump David's DeFi University, right after we do that live launch on October 7th at 1 p.m. Eastern Time, we're going to do it on this show. We're going to do a full walkthrough of metrics, a full live masterclass. And we're also going into DeFi University, and we're going to be doing something similar, but probably in a greater amount of detail. So if you guys are ready for that, make sure you're in DeFi University. Make sure you're subscribe to Mike's channel, obviously. with notifications turned on so you don't miss out on the live show. And you might even see me in some other communities working it out with some other people in this space and everything like that. But super excited because we have a ton of stuff. We have a way that you can save money using metrics. I'll just seed that out there. Something that a lot of people have requested that we bring back. So we'll be doing that soon. In terms of what I'm doing over on liquidity pools right now, since I've been so busy, again, you can ask my girlfriend. She's like, yeah, this dude is on his computer at 3 a.m. in bed, typing away, and everything like that. But I haven't been too active in liquidity pools. The pools that I am in, I've just let them do their thing. I have this WBNB to link position over here. This has been out of range for like a week. I just haven't had the chance to do it. And honestly, I don't mind being all in link, especially while I wait for it to perform. So I haven't had the chance to rebalance that. And then in terms of hyperswap, I have a wrap hype to UBTC position over here as well, which has about $25,000 of capital in it. Now this is doing a 100% APR. So that tells me two things. Number one, my range is probably too tight because I do have like probably about 20% earnings retention. So going in with a broader range, I'm fine cutting that 100% down to like 70% or something. If it means I don't have to manage it as often, if it also means that I'm going to slow down my divergence loss. And then on top of that, I'm going to bring more capital into this position because it's been doing very, very well. And I've been solidifying a couple positions just to the backbone of my portfolio. So capital from Tau, about $7,000 of this is coming in. About 4.5 of this ETH right over here is coming in. Basically 3K of this ETH is coming in. Along with eventually I have some capital over on Hyperliquid from that Ethereum position that I ran as a contingency strategy that's also coming in of about like 6K or something. So again, I'm going to be ramping up more deployments and whatnot and preparing for this run, capitalizing on the volume and flywheeling the growth. So excited for that.
Bro, that looks great. So, Jake, I can't say enough good things about the tool set that you've built over at Metrics Finance, and I really can't wait to have you in DeFi University to walk through it in detail. That's going to be a lot of fun, man. I'm really looking forward to that. And these LPs, I've got a question for you, Jake.
Yep.
So, if you think that we're about to see some type of alt season run, would you prefer to be in LPs or to be in spot? And what is the intent for these LPs here?
Great question.
Yeah, it is a great question. In the instance where we are about to see alts running, I'm primarily going to be in spot, right? And the reason why is because, again, as the market
real quick, when Jake and David are saying spot, and I don't mean to insult anybody, but I know we're all at different levels. Spot just means you're hodling. You're just holding the asset. It's not in DeFi. It's not in anything. It's just in your wallet. It's on a centralized exchange. Just want to make sure everybody understands that. Sorry, go ahead.
100%. Yeah. In terms of spot, basically, it's because as the market moves, I'd be getting drastically sold out of the altcoin into a standard crypto asset, which in the instance of stuff like, Ethereum to Link, let's just say, while the market is favoring Ethereum, it actually works out quite well because I can basically ladder out of my ETH into Link and prepare for alt season by just holding Link. But in the instance where we're about to see an alt season, that is where I'm starting to rotate. So you're going to see me in more blue chip liquidity pools, David. So I'm talking if I'm ready to ladder out of my actual like ETH and stuff like that, ETH USDC, or in the instance of maybe ETH BNB pools, Wrap Bitcoin BNB, stuff like that, Wrap Bitcoin ETH. Those pools where performance starts to become very, very closely correlated and the actual pair price starts to become very, very low volatility, basically. And then taking a look at altcoins themselves, that's where I'm going to want to essentially minimize my LP exposure, at least have a broad range. So if I am diving into altcoins, let's just say, I'm going to show you guys an example on Link to BNB because that's just the one that I'm in. So let's pull this up over here.
So I'm curious, Jake, why did you select Link BNB?
Good return at the time, good correlation, and I want some exposure to BNB, man.
Yeah, for sure, I get it.
Yeah, that one's at like a 10% profit right now or so. So I'm pretty happy with that so far. But
I actually really need to start growing my link bag. I need to find some
Link,
nice LPs.
Link's a
So
great
what
app.
do you, so Jake, Mike, what do you guys think about all of the news recently about Linnea and Link
Oh,
and
don't
Swift?
get me started, David. Don't get me
I
started.
couldn't help myself, man.
Well,
I, I
I'll tell you what I think. So, it's to me, it's been a little bit entertaining, and I again don't mean any offense to anybody that holds XRP, but I personally got out of it, quite a while ago when they started talking RLUSD and things like that, because I kind of saw their narrative shifting, and I think that they saw the writing on the wall. But when Swift announced the partnership with Link that gives that interoperability, and by all means, you gentlemen, correct me if I'm wrong here, but my first thought was that gives Swift access to multi-chain liquidity. So deep liquidity across multiple chains, multiple stables, real world assets, all of that. And then Linnea is the messaging aspect. So that's going to be built out for that, what everybody talks about, the ISO 20022, messaging, format and things like that, that needs to be, that everything needs to use to be compliant with the new standards. And almost overnight, like it happened yesterday, pretty much, where all of a sudden, like all the XRP maxis, all of a sudden they found some third party roundabout way that was partnered with Swift, and somehow now they're saying that Ripple is going to be a partner of this, and that's going to be a partner of Swift, and so now somehow Ripple's re-injected into the whole narrative.
So Mike, you know what that's called? That's called cognitive dissonance.
called
So
Yes.
coaching.
when when you're presented with evidence that runs contrary to your deeply held beliefs, instead
Mm-hmm.
of looking at that evidence and saying, "Oh man, well maybe I was wrong about this conclusion," instead what people do is they double down on their incorrect beliefs because they
Yeah.
can't get over that dissonance. So,
Oh yeah.
and
yeah.
that's what I did. Not that. That's not what I did. I should say, because like I said, when I started seeing the RLUSD narrative, and that USDC was going to be added to the XRPL, RLUSD was going to be added to ETH mainnet, all of that. To me, just after 3-4 years of learning about Ripple, XRP, XRPL, and all that, I just saw a diminished use case for XRP. If RLUSD is going to be, at least partially used as that vehicle to transfer value, then it diminishes, XRP needing to be a high valuation like they always talked about.
Yeah, but
And
that doesn't that so that Mike, that whole idea, so just thinking about the whole idea of XRP as a cross-border payments currency, that idea doesn't make sense.
It
Like
doesn't.
I
why in the world would an institution want to swap into
volatile
XRP?
asset. Yeah.
Why would you ever do that? That doesn't
Well,
make any sense.
not to mention, David, it's like in that instance, they do swap into an XRP. Then as soon as the receiver receives it, they just go and they sell the XRP. Because they're not going to go to the grocery store and pay out XRP. More importantly, on a B2B scale, they're not going to go to their vendors and start paying them in XRP. They're not going to start paying salary to an employee in XRP. So it's like something like that never made sense to me,
Yeah.
Yeah,
and
the idea never made sense to me either.
the YouTube, I think that it's all driven a lot by just hype on Twitter, YouTube, email lists, forums, all these things of the people saying XRP is going to go to $100, $1,000, $2,000. I've seen $10,000 price prediction.
I
I'm
Yeah.
like, this
So
is so
it,
out of this world
I know, man.
ridiculous. Like, do we know
Jake,
the concept of market caps? Like,
You know what that kind of reminds me of a little bit? You ever talk to an AI, a model, and it hallucinates and
yeah,
it tells you something that's just blatantly false, but it says it in such a confident way that you're like,
Mhm.
oh man, I didn't
right.
realize that the sky was
Bumblebee.
purple. Maybe I should go look outside.
Yeah.
Well, I think that that's kind of what happens on YouTube and X with a lot
Yeah.
of this XRP content. It's a lot of it is, I think, either just misleading or like people just make stuff up, man.
There's a
But they
lot of
do it,
that.
Here
and
we go.
there's a lot of that.
Secret XRP plan has been leaked to go to $1,000 per coin by Donald Trump himself. By
Right?
Donald Trump himself, guys.
Sure.
Well, and I agree. I agree with Ellie here. I honestly believe there's at least some of these people that are paid because it's
Gotta be.
either that
Yeah.
or they just know that if they post something bullish about XRP, it's going to get a lot of engagement,
It will.
and so it's a great way to. I would rather have integrity and be honest than get clicks. It's just to me, it's just a very cheap way of growing your brand. But
You know what else, Mike and Jake, is so funny about XRP? They're stable, RLUSD. The majority of the liquidity exists on ETH mainnet. Like, how
Yeah.
does that make sense? Like, come
I
on
know.
now. Yeah,
Well,
that's kind of funny, man.
a cross-border payment right now. I mean, I could be in Portugal, I could be in Spain. I can send David or Jake, USDC for free from my Coinbase account, and I just did a cross-border, remittance or payment, and it cost me nothing. You guys got it. You can swap it into anything you want.
Mhm.
Use it in any way you want. David could
So
use it, with his EtherFi, card.
Oh, dude,
It's
EtherFi is great, man.
you know
EtherFi
what I'm
is
saying?
really great. So here's the funny thing about XRP. So even though it's true that it's a bullshit project, it is also true, I think, that it will probably pump. I think XRP will
Yeah.
probably pump massively on an alt season.
100%.
So it's like you got to
Well,
be able
because
to
there's
hold
endless
these.
people that think they're going to get rich with 100 XRP.
I think it comes down to availability heuristics. I think that it's just so ubiquitous. It's all over the place.
Mhm.
People talk about it a lot. And unless you live, eat, sleep, and breathe this stuff and really know what you're talking about, it's really easy to see some content talking about XRP and fall for it. But it'll probably pump, man. Like we're
Yeah.
probably going to see XRP at like $4 or $5, maybe higher than that, just
Well,
because
that's how it
it'll
got to
pump
where
along with everything else.
it is a bunch of social media. People, see that, XRP is going to be the new US dollar. And they see all these posts and there's so much of it out there, when they see it, multiple times from, different outlets, they're like, oh, it must be true.
Yeah, yeah, yeah.
And so, yeah, it's sad. I mean, I'm out there screaming from the rooftops, trying to at least snap people out of it. It's like, yeah, you'll like David said, you're going to make a little bit of money. If you buy in right now, you might make a 2x or something like that. But it's not going to $100 or $10,000.
And
You're
just
much better off.
understand too, Mike, that it's basically a meme coin.
Yeah.
Yeah.
Like what exactly? Like it's $180 billion meme coin. Like it's the OG meme coin. It's never done anything. It never will do anything, and yet it's got $180 billion valuation. So
Dude,
really
it hasn't
interesting.
reached its all-time high from 2017.
Yeah, man. Well,
It's
so Jake, I want to ask you something about LPs.
yeah.
So, Mike, is it okay if I share my screen real quick? I want to share. I want to ask Jake about a couple of my LPs here.
Yeah.
So, I've got Revert opened, and I just want to see if I can get my screen share up so that we can talk through this. Because as I rebalance, and just want to make sure you guys can see this, yeah.
Mhm.
Yeah. Yeah.
Okay, great. So, Jake, as I have been actively rebalancing these LPs, and notice up top I have add exited,
Mhm.
and I have my reference value set to hold, not to USD. I have it set to hold. So, as I've been actively rebalancing these LPs, I have realized divergence loss,
Yep.
and yet my P&L here, in hold terms, is positive. So just a couple of weeks ago, um, I had almost $25,000 of divergence loss that I had realized in these pools. And the way that Revert calculates it, it's your impermanent loss or divergence loss only occurs while your position is active and in range.
Mhm.
But this hold reference value, it's kind of sort of a back of the envelope and permanent loss calculation, and it continues to run even when your positions are out of range.
Yep.
So, my question to you, Jake, is as I'm actively rebalancing these LPs and realizing divergence, Do you know of any way to mitigate divergence? I don't think that there is. I think that it's just something that's unavoidable and inescapable as an LP, that you're going to have to contend with impermanent loss. And my thought process here is that there's a sweet spot for setting ranges.
There is.
And yeah, I think that there really is. And I think that it has to do with the volatility of the underlying and with the volume in the pool. Like, how quickly will your fees take you to positive divergence? But Jake, how can you mitigate divergence? Do you
Yeah,
know of any? Yeah.
it's a good question. So in terms of like mitigating divergence, here's what you have to think about. If you go in with a plus 10% minus 10% range, and let's just say you have 10% divergence loss, and then you have 20% in fees, let's just say. If you go to a plus 20% minus 20% range, you all of a sudden have 5% divergence loss and 10% in fees. It is a linear equation, right? Of how much fees you get compared to the overall divergence loss that you have. It is exactly linear. But here's what's not. It does not account for the fact that you're going to be rebalancing less often. So you're going to be locking in less divergence loss, right? It's not going to be finalized. And then on top of that, it's not accounting for that. It's going to bounce in range, out of range, or sorry, it's going to bounce within your range. It's not going to go out of range as much if you do have a broader range. So while the math and on paper says, oh, I can just go into a tighter range pool, produce more income, right? Sure. What the math on paper does not say is that with volatility, if your range captures volatility perfectly within range and you don't have to rebalance once, you're going to end up with more money than if you have to rebalance because you bounced out of range and then rebalance when you came back in and then rebalance when you bounce out, you know what I mean? And so on and so forth. The math does not account for that on paper. So when it comes to mitigating, you're absolutely right. There's a sweet spot that captures the volatility. And then on top of that, I would like to say just contingency, because again, it's all about using divergence loss to your advantage and identifying cool opportunities in the market when it comes to you actually having that divergence loss. Like, okay, let's just say shit the bet on this position. Can I take that money and just like go throw it 1.5x leverage on ETH or something like that and make that money back? Or is it better to throw it into this position? Or this position's down. Maybe this one is an up and coming position. Should I throw it into here? It's a similar industry. Those are the types of strategies that I'm looking at personally, basically.
Yeah, yeah. So Jake, it was interesting to hear you say that the relationship between volatility and divergence is linear, because my understanding was that it was a nonlinear relationship. That as an underlying asset becomes more volatile, the yield that you must earn to have a shot at beating divergence increases with a square. So that means that as an asset becomes more volatile, you must earn exponentially more yield to have a shot at beating divergence. That
Mhm.
what that means to me is there are certain pairs, certain crypto pairs, pools, I mean, that I just would never provide liquidity in, because either the assets are more volatile than ETH or Bitcoin,
Mhm.
or the volume just isn't there. So that's comment number one. Comment number two here about what you said there, Jake, was there is definitely a sweet spot. I agree with you 100% on that. And if I just take a look here real quick, I want to share something with you. I
Mhm.
think that if you set a range that is, let's say, plus or minus 10% wide, that's a 20% wide range. Well, yes, it is true that you may not have to rebalance that position as often as a more narrow range position, but when you set a more narrow range, not too narrow, but just more narrow than plus or minus 10%, maybe plus or minus 5%, when you set a more narrow range, because you significantly increase your fee APR, you can get to positive divergence more quickly.
Mhm.
So that's kind of the trade-off, right? Where if you set a wider range, you don't have to be as active managing your position, but I think you would actually have potentially a greater amount of divergence than if you set a more narrow range position. So I've just been thinking about this using this back tester over here. So this is with a plus or minus 5% wide range, and I just use 10 ETH, just as a for the sake of this example here. So this is interesting to me. You see, over the last 30 days, as I just changed this to USDT, so now it's saying over the last 30 days, this has spent 71% time in range. Take a look at the divergence, though. Basically negligible, because ETH has been so volatile over the last month. But if I were to set maybe a plus or minus 10% wide range, my divergence increases and the time in range is the same. But which is best? Actually, the time in range is 100% here.
Yeah.
So if the time in range is it just took a second to update. So if the time in range is 100%, so it's in range the entire time, you don't have to rebalance, but your divergence is greater and you're earning a much, much lower fee APR. Is it better to set a wider range or to set a more narrow range? What do you think?
Yeah, so in this instance, I would say the sweet spot is probably going to be around the middle of that. Because if you look at this one, 72% in range, 80% fee APR, it's showing your divergence loss is negative 12.35. I don't know why it started at 8, but it shows 12.35. Then if you do that 10% range again, David, it will show that like 12.11. So slight difference, of course. Just give it a sec to update. Some of this stuff is really cool. I really want to get it on Metrics Finance. It's just it's like
The back tester, yeah.
backlog.
It's just that the
Yeah.
plus or
So
minus 5%. I'm sorry. Go ahead, Jake.
no, you're good. I was just gonna say in this instance now it's a little bit less, like by marginal amount, like 30 cents or something like that. And then the APR is 61% or so.
Yeah, the thing for me though is I think that these fee APRs are understated a little bit.
Mhm.
My realized yield has been, much, much greater than that. Now, I'm not in a plus or minus 10% wide range for any of my LPs. I'm plus or minus 5% wide.
Mhm.
And so I just clicked on plus or minus 5 one more time, waiting for this to update. So if the time in range for a more narrow position, a plus or minus 5% wide position, is 72%, then that means that, if I take a look at my total fees here, I could actually add 30% to this because I always keep my positions in range. So if my divergence is similar to that of the wider range position, but I'm earning much more in yield, well, it would seem to me that the sweet spot for this specific ETH USDT pool is probably a little bit more narrow,
Mhm.
maybe plus or minus 5, something like that, plus or minus 5% wide. So what do you think about that?
Yeah, I mean, I think like the sweet spot would be probably around like 6. I mean, I would say I don't know, and that's why it's cool to test things out, especially with like a back tester, um, because you can almost find the thing, and there's got to be like a way to like again like stuff that we're working on with indicators to see like almost predict the best possible range based on volatility. I actually
Yeah.
saw. I want to give a big shout out to what do you call it? A guy, and I kind of had this ideation a little bit ago, or just like kind of like, oh wait, with liquidity pools, we focus on correlation, right? The more correlated an asset, the better, lower the divergence loss. And while that is true, it's not true for the specific reason of highly correlated equals lower divergence loss. It's not that specific reason. What we considered back when we didn't have correlation on the Discover tab because it was costing us too much to have it was, well, if we're looking at price volatility measures the volatility within a specific pair. Couldn't that be a better measurement of whether you are going to have high or low divergence loss? Which it is. So this guy over on Twitter, Rich, and he has a YouTube channel too, is Richard HSU. I'm sorry, I don't know how to pronounce his last name, but he made a post about this, basically saying, and I'm gonna, what do you call it? Pull up that post over here, Mike, if you can.
Yeah, it's you should it should be displaying.
Awesome.
There you go. Yeah, the side that on the streaming software that says live preview, that's what's live.
Here you go. Awesome. Yeah, it shows offline right now for me.
All right,
With my screen showing.
here we go. Give me 1 second.
Okay, here we go.
Let's see.
Let me just
Oh,
reload it up.
yeah, reloaded on there. There we go. Let's hide David's. All right, there we go. Oh no,
Um,
that's me. Sorry.
I'm like, I'm not on Aerodrome.
Let's see. Let's hide mine now.
I don't have active locks on Aerodrome, Mike. I'm like, I'm just joking.
I am not. There we go. Much gooder. Okay, we got it
Much,
now.
much more gooder.
Yes, much more gooder. No,
No,
I'm getting ready to talk about it. I want to make sure that everybody in the community doesn't forget to do their votes on their
oh yeah.
black hole locks and their aerodrome locks.
Of course. Yeah. Well, in terms of this Richard guy, again, great post because I had this like visualization in my mind like a while ago. I'm like, wait, couldn't we just use volatility as a measure of if a pair is going to have a lot of divergence loss or a little bit of divergence loss? Because this volatility number on metrics is based on the pair price. So in instances of ETH USDC measures the volatility of ETH basically, but in the instance of like CBBTC to wrap Bitcoin, it's measuring the volatility of the actual price of CBBTC to wrap Bitcoin, right? Which would be around 1, basically. Ethereum Link, it's measuring the volatility of the price of Link per Ethereum, basically. So what he essentially said is correlation doesn't matter when it comes to LP and alt ETH pairs. A ton of people use correlation metrics provided by apps like DeFi Llama to find pools that are correlated, and the aim is to minimize impermanent loss in tight range strategies. But this metric is misleading because it doesn't measure volatility, which is the cause of impermanent loss. Cause of impermanent loss is if essentially the price, not the underlying asset price, but the price of the pool adjust, right? And that's why I call it divergence, because the two assets are diverging from each other. It only shows an asset tends to move in the same direction, but not by much. It doesn't tell you anything about relative strength. Makes more sense to swap some BTC into ETH BTC LP when ETH is relatively cheap compared to BTC, but correlation won't tell you that. The metric is measuring historic data. Past performance doesn't predict future performance. You can make a ton of profit LP in non-correlated assets like Pendle while ETH dumps. This allows to close LP and profit into ETH for an ETH profit, basically. Which it's a very, very, very good take, right? Because again, correlation, while it can lead to lower divergence loss, and that's how we've all seen it, right? It's not a perfect indication. If you want a better indication, you can look at price volatility, right? But also price volatility, again, it's not going to be completely linear. But if we were to look at price volatility, say lower than, 4% in this instance, right? You're going to see stuff like,
I'm sorry, Jake. Let me just cut you off for a second. Over what period of time? So 4% over what period of time?
so in this instance of Ethereum to USDT, we are looking at 30 days.
Okay, gotcha.
Yeah. And if we look at 14 days, we're looking at a little bit above 4%. And if we look at 7, we're at 4.5%. And, if we look at 3, we're now at 4.08%. But when we take a look at this over here, if we just sort by TVL, highest TVL, and I'll go to page like 3 or something, right? We're going to see a lot of highly correlated assets when we look at these, whatever you call it, lower price volatilities. Like, for example, when we're looking over here at Badger to BTC, 2.5% price volatility, 0.9 correlation. LBTC to EBTC, these are derivatives of Bitcoin, obviously pretty high correlation. There are going to be some instances, though, where let's just say USDT to wrap Bitcoin has a 2.75% price volatility over 14 days in this instance, but negative correlation. So those are the opportunities. Like over this 14-day period, we probably could have made a profit LPing, just simply this liquidity pool compared to divergence loss, basically, because it has low price volatility. So that's something that we're actually looking into. Like, how can we better use this metric to set our ranges and whatnot? So, yeah.
Yeah, but Jake, what's so challenging about using correlation like that is correlations break down. and they can break down quickly.
Yeah.
And a correlation for ETH and BTC over a 14-day period of time is going to be different than it is over the course of a year.
Yeah. 100%.
So, and if you take a look at a chart, just using ETH BTC as an example, if you take a look at a chart of ETH BTC, well, what you're looking for with a really tightly positively correlated pair is a chart that's moving sideways. That's what you would be looking for. And
Yeah.
last I checked, ETH BTC is not moving sideways.
It's not.
So,
No.
one of the most tightly positively correlated pairs out there with a lot of, a lot of volatility. So, there's a platform for statistical arbitrage,
Okay.
called cryptowizards.net. And the tool that guy's built is really, really good for stat arb. I get the sense that we need to be looking at more than just correlation, but also co-integration. There's a bunch of jargon for statistical arbitrage that I think could be useful if you've got a mathematician on your team, Jake, who'd be able to take a look at this stuff. But it's more. It's not just about the correlation. It's about a lot more than that.
Yeah. And that's what I wanted to speak on. We've used correlation for the longest time, and we've always known, like, hey, higher correlation typically does lead to lower divergence loss, right? There's a path there, but it's not specifically because the assets are correlated. The actual specific reason is because of volatility, and how much the market moves and price movement. So if there's a better way to measure price movements of a specific liquidity pool price, then that, lower price movements, obviously the higher probability you're going to be divergence loss, assuming that their earnings outweigh. So I'm going to take a look at
Right.
Crypto Wizards.
Yeah, it's all about the fee APR. Well, volatility, volume, how wide your range is, how much you're able to generate in yield, how quickly you can get to positive divergence. And I think that there's a valid reason. I think that people call stablecoin pools divergence loss factories. Well, because they are.
Yeah.
Divergence occurs to the upside or the downside. If you're paired with a stable, then you're going to face a lot of divergence loss. The only way you can beat it is by earning enough in yield to overcome it. So yeah, I'm paired with stables on mainnet and base, and I've experienced a ton of divergence, but my yield is greater than my divergence. So I'm positive,
Yeah.
and the only challenge for me, Jake, is when I'm looking out over the next couple of months, and I think to myself, where are we headed from here? I feel like I've got too much capital in LPs right now, and that I need to migrate back over into spot a little bit more. So
Yeah.
that's all I've been thinking about.
Going into alt season, I'm like going to be probably 30% in LPs, and then the majority of my non LP holdings will be in alts. Probably like another 40%, I would say. And then on top of that, I'll use the other 30% that's probably lending blue chips on Aave or something. I'll use that to borrow and add more to LPs, most likely crypto stable LPs, because I'm just profiting as the market moves up and whatnot, generating some yield. And in those times, I'm probably, as the market moves up, going to be using that yield to pay down the borrow that I borrowed, basically. That way I can kind of over time lower my overall risk, get ready to sell the market.
Hell yeah, man.
Basically, what I'm doing is what you guys just talked about, but I did that a couple weeks ago, where I pretty much, other than a couple little degen, like a couple $100 here and there, I think total I got like $2,500 and some LPs that I'm using to try to grow like an XPL position and some things like that. But for the most part, I'm all out into spot and just waiting for hopefully this October, and November to play out, because I mean, you gentlemen are in a much different position. You've been in multi cycles. You've kind of made your nut. You have kind of larger bits of liquidity to be operating with. To do the things that you want to do. This is my first bull cycle. So, I'm trying to churn my, 60, 70 grand into, 5, 6, 700 grand, so that I can
Hell
do,
yeah, man.
you know what I'm saying? It's like I'm I'm the little guy. I'm trying to get up and swim with the big fish right now. So, but yeah,
Yeah.
that's what I've been. Our community on Discord. That's kind of what we've been talking about. And I'm glad we had this conversation. Was for the past couple of weeks, we've been like, hey, what moves should we be making right now to best position ourselves for what we hope to be, a solid alt season. And me personally, because I'm trying to, make a big splash. I'm not in Bitcoin. I'm not in ETH. I'm very few even blue chips. I'm in very, very what I feel is fundamentally very strong alts that even if I hit one or two of them, I'm going to do very well.
Mhm.
Um, Under no illusion that all of them are going to do something. I'm sure a couple of them are going to go to zero, or they're not going to go anywhere. But I just need the two or three of them to do something awesome. Do like a 10 or 20x, and I'm good.
Yeah.
So that that's
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 right.
kind of what I'm doing. But just closing thoughts. David, where are you at now? And I know you've covered some of this, but where are you at now? And over this next week or two, what adjustments are you going to make? For in your portfolio, hoping for alt season.
As of right now, Mike, I'm not planning to make many adjustments aside from buying back the ETH that I borrowed at 4,500. So on Aave, I've got 40 ETH that I have borrowed at 4,500 bucks, and I plan to swap those borrowed ETH for stables on the way up. That will give me more leverage and more positive ETH deltas on the way up. So that's the only change that I'm really thinking about at this moment in time. But as I look out over the next couple of months, I mean, it looks like we're going to continue to melt up. It looks like there is a ton of liquidity out there. And, sentiment is really not euphoric. So that tells me that there's room for more upside. And I think that it would not surprise me to see the S&P at $6,900 by the end of the year. That would fulfill the prophecy as foretold in the SPX 6,900 prophecy. So that would be really, really cool to see. But I think that it's going to pull. I think that these AI names. I think that positive correlation between Bitcoin and some of these AI companies. I'm thinking about Nvidia and Tesla. I think that positive correlation probably won't break down over the next couple of months. I hope it does. I hope that Bitcoin is able to rip regardless of whether Nvidia and Tesla push higher. But I think that we go much, much higher over the next couple of months. It would not surprise me, you guys, to see Bitcoin at 200,000. I mean, it would not surprise me to see ETH at $6,500 by the end of the year. That would not surprise me at all. I'm not playing for that, but if we get some type of true alt season, like a quick breakdown in Bitcoin dominance over the next 75, 80 days, man, we could see some moves like that. We could see some moves like that. So, yeah, really
Your
looking
mouth,
forward
God's ears.
to the rest of the year, man. That's right.
All right, Jake. Like I know that you've covered a little bit, but just kind of a quick summary. What's your portfolio look like now, and what adjustments are you making in the next week or two? Hoping for a strong October.
Moving to broader range, low vol pools, still crypto assets. Starting to kind of shift some of my buys obviously into primarily altcoins. Hold a decent bit of altcoins in my portfolio. So and probably have about 30% of my portfolio in LPs at this time. So yeah, and leverage up, man. Leverage.
Awesome.
I like
All right.
it.
Well, gentlemen, as always, I appreciate the freaking strong alpha that you bring every Wednesday and Friday. Everyone out there that's watching, if you could, please like the stream. It helps immensely to grow the channel. Again, we're not monetized at all. So anything you can do to help us grow the channel and get this good quality content out there, non-hype based content. We would definitely appreciate it. So, gentlemen, till next time. Veteran Crypto out.
Peace.